Hey everyone, FinTech here, and in this video, I'm going to go over my top 7 stocks to buy right now. These high growth stocks are all positions that I currently own and are the stocks that I think have the best potential of making a very positive return going forward. And if you've watched any of my portfolio reviews before, this should be an interesting one since a lot of these positions have rebounded off of their all-time lows and started making some gains recently. So let's not waste any time and let's go ahead and dive into my Charles Schwab account, which I'll be sharing for the entire internet. So I have pulled up here my actual stock brokerage account in which I track all of my different stock positions. And we can see here that over the past month, it actually had a positive return of around 9%, which is honestly pretty much a first for the last year. If we go to the year to date, we can see that since the beginning of 2022, my portfolio has pretty much been in a steady decline that entire time, down around 42% overall. Now that is amid a drop in the overall S&P 500 as well, but these stocks have dropped even more than the S&P simply because they are more volatile and they focus more on growth and technology. I think most of these positions are down simply because the market is revaluing them rather than because the companies themselves are making less money. So let's now dive into each of my individual stock positions, and we'll start with the smallest positions and then move up to the largest positions. So stick around to the end to see which stocks I think have the best chance of having very positive returns going forward. So the first position we're going to talk about today is Upstart, which I currently own 124 shares of at a value of $3,300, and that's off a cost basis of $28,000. So this is by far the worst stock in my entire portfolio in terms of performance over the time that I've owned it. Now, Upstart is an AI company. They offer AI lending services. So if you think of a traditional loan, the way that you qualify for a loan is through your FICO score, which is a single number that represents how qualified you are for a loan. Upstart replaces that single FICO score with thousands of different parameters that they can feed into an AI model, allowing them to get a much more accurate prediction of how risky you are to loan money to. This means that if you're a well-qualified buyer, they can give you better interest rates than anybody else. Or if you wouldn't qualify for a traditional loan, they might be able to offer you a loan that your traditional FICO score would disqualify you for. Now, you might think the fact that Upstart is down so dramatically from its peak, I think it's down around 90% overall, would mean that there must be something wrong with their AI model. But in reality, Upstart's drop in price has mostly been due simply to macroeconomic events that are outside their control. Upstart recently pre-announced their earnings for Q2 2022, which will be officially announced in August. During that pre-announcement, the CEO called out several factors that were impacting Upstart's revenue in the short term. These fears included inflation and recession fears that have driven interest rates up and then put banks and capital markets on cautious footing, and the fact that their revenue has been negatively impacted by two main factors. First, the fact that their marketplace is funding constrained, which is driven by fears among the macroeconomy, among lenders and capital market participants. And then second, the fact that they took action to convert loans on their balance sheet into cash, which, given the fact that interest rates are rising so quickly right now, resulted in a negative impact on their revenues. That being said, while Upstart's stock price in the short term is being pushed down and they pre-announced earnings because they are expecting to miss their revenue guidance this quarter, at the same time, their AI models are still working. Sanjay Datta, the CFO of Upstart, said, "Despite the tumultuous economy, Upstart-powered loans have performed exceptionally well. In fact, their average returns have consistently met or exceeded expectations since the program's inception in 2018. So at this point, Upstart is a little bit more of a speculative play and less of a traditional growth play, which is why this is the smallest position in my portfolio and why I sold some shares in this company earlier this week. That being said, I'm going to hold some shares in Upstart for the next Q3 and Q4 earnings to see if the stock price is pushed down a little bit too much, if we're going to see a rebound as the economy starts to stabilize. Now, while I can tell you all about the stocks that I like, how do you decide whose opinion is worth listening to? And if you don't see how people's previous stock picks are performing, how do you know if they're any good? Well, this video's sponsor, StockToMe, is revolutionizing the way people find information and opinions on stocks. Users of this app can post their opinion on a stock, and then based on whether or not they were right about that opinion, they can build up their reputation over time in the app. This is actually a really cool idea. So let's say I post an opinion about Apple. You just pull up the app, search for Apple, put in your sell price, select a date, and then give a reason for why you're setting that sell price. Once it's posted, others can see your opinion, and you can also go in and look at other people's opinions and see how well they are actually performing. Here's a short opinion from Matt on Mullen Automotive that's up 33.5% so far. But if we tap here, we can see that on average, he has made a loss of 11% on his opinions. So sorry, Matt. Users can post stock opinions, build their reputation, gain followers, and find reliable stock information using StockToMe's community. Plus, if you sign up now using the link in the description, StockToMe is currently running a contest where they will give out $1,250 in prizes to the top performing opinion makers on their app. StockToMe is completely free to use, but you can upgrade to a premium account for only $4.99 a month. With a premium account, you can win 10 times more for being a top opinion, plus you can view additional opinions such as reasoning, sentiment, and StockToMe community while also commenting on posts. So scroll down to the link in the description to get started with the StockToMe community today and maybe even make some money posting your opinions. And now let's move on to my next stock pick. Next up, we have ZoomInfo, which I own 194 shares of at a value of $7,000. And that's off a cost basis of $12,000. So this stock has lost around $5,000 overall. Now you'll notice that Charles Schwab is giving this stock a D rating along with most of the stocks in this portfolio, but the entire time that I've owned some of these stocks, they've had those ratings, including companies like CrowdStrike, which I ended up making a 200% return in over the time that I held it. As far as I can tell, Charles Schwab just does this rating based more on a value metric than how well they think the stock is going to perform, and so technology stocks and high growth stocks are probably going to be ranked lower by Charles Schwab. Now ZoomInfo marks the first of my sort of mid-sized positions that I hold in my portfolio. They're growing at 58% revenue year over year, which is a rock solid growth rate. They've basically maintained above 50% growth for the entire past year. And part of the reason for that is that ZoomInfo is a B2B business, meaning they make most of their money by selling to other businesses and enterprises rather than to consumers. This is a really good thing if we do start to enter a recession, because consumers are going to cut their spending a lot more easily than a business that's paying for a product that is making them more money, which ZoomInfo does. ZoomInfo offers data services where they can connect a seller to someone who wants to be sold to. So they remove a ton of inefficiencies in the marketing space and make their clients more money than they cost them. Even though ZoomInfo's stock price has been declining, the business is doing better than ever. They have very positive net operating margins at positive 38%, and they grew 58% on revenue of $900 million. Plus, they recently launched new services like Marketing OS this past quarter, and they acquired Comparably, which is a suite of software as a service solutions for recruitment, marketing, and employer branding. While ZoomInfo doesn't solve all the problems in sales and marketing yet, they're getting closer to becoming the one-stop shop that any company can go to solve these issues for them. And so because of that, they should be more recession-proof than most other companies out there. My third smallest stock position overall is Sentinel One, which I own 274 shares of at a value of $7,200. And that's down from an initial basis of around $13,000, so a little bit under a 50% drop. Now, Sentinel One works in the security space. They're kind of like a super advanced antivirus. Sentinel One uses a bunch of different AI models to track threats against companies' securities, and then they can use that AI to proactively identify new threats without them having to be manually found out and captured. They are doing extremely well at this, as the company is currently growing at over 100% per year. In fact, if we pull up their earnings over the last couple quarters, we can see that revenue grew 110% last quarter, 120% the quarter before that, 130% the quarter before that, and again around 120% the quarter before that. So maybe there's a slight deceleration in revenue, but overall the company is still growing very quickly. One of the reasons I invested in this company is because they look a lot like another company I used to invest in, CrowdStrike, which I owned for a couple years and in total made around a 200% return on the stock. So I 3x'd my total investment. Now, we've yet to see if Sentinel One can scale as effectively as CrowdStrike was able to do, especially seeing as CrowdStrike is still out there and competing with this company. But if they're able to do so, there could be substantial upside in this stock. And now we're going to move out of my mid-sized positions into my 4 largest positions in my portfolio, which represent the stocks that I think have the best chance of doing well going forward. First up, we have Cloudflare, which I own 317 shares of at a value of $15,000, and that's off a cost basis of around $20,000, so it's down around $5,000. Now, in reality, the way Charles Schwab calculates the cost basis is based on first in, first out money, and so I've actually sold some Cloudflare shares at a higher price than I'm at right now, and then I've also bought more shares in closer to the peak. So this shows a little bit more negative than the overall performance actually would be. Now, Cloudflare is a company that's trying to make the internet itself work better. They started out as a simple CDN provider, offering website hosting services and a firewall to protect those websites. But they quickly realized that there was a lot more opportunity in not just blocking bad actors, but optimizing the experience for good actors. This is one of the most innovative stocks that I have ever seen, and probably the most innovative in my portfolio overall. They've launched product after product every single year like clockwork, and they've grown a rock solid 50% growth rate for half a decade at this point. Now, granted, all of that growth has been during a bull market, so we'll see how they fare in the potential upcoming recession. But Cloudflare is going to report their next quarter earnings on August 4th, and so we're going to want to see them maintaining that 50% strong growth rate that they've seen before and continue to innovate and launch new products over time. If they can simply maintain this growth rate long enough, the company's growth is going to continue to be exponential like it has been before, and as the stock price is dropping while the company is becoming more valuable, that gap in value is an opportunity for us investors. My third largest position is ZScaler, which I currently own 112 shares of at a value of $17,000, and that's off an initial basis of $27,500, so it's down around $10,000 overall. Now, while the stock is down over the entire time that I've owned it, it is up over the past month, around 5.8%, which is why Zscaler is now my third largest position over Cloudflare. It actually jumped it during the past month. Zscaler offers another product which is fairly recession-proof. They offer zero trust security to enterprises. So in a traditional security model, you think of protecting everything inside your network. As long as all the bad guys stay out, you're good. The problem is, if a bad guy gets into your network, they now have access to everything. Zscaler gets around this by providing zero trust, meaning every application, every computer, every person on the network has to authenticate before they can communicate with anybody else. This makes the network way more secure from potential bad actors getting into your system, and it's extremely important for companies that are moving to the cloud, which is partly why Zscaler has seen explosive growth over the past several years. Zscaler is growing even more quickly than Cloudflare. If we look at their revenue from a year ago, they were up around 55%, then they were up 62%, again up 63%, and then in their most recent quarter, they grew an additional 62.5% year over year, which makes sense because considering the accelerating landscape of security threats that more and more companies are facing and the acceleration of companies moving to the cloud, a product like Zscaler is essential for protecting them. Whether or not there's a recession, you have to protect your actual business. Zscaler also has a 125% net customer retention rate, which means that for every dollar a customer spends this year, they're expected to spend $1.25 next year, which is a sign that customers really like the product, and once they sell a customer onto the platform, the customers just want to use it more and more over time. My second largest position overall is Snowflake, which I own 160 shares of at a value of $24,000, and that's off an initial investment of around $30,000, so it's down around $6,000 overall. Now, Snowflake is a company that I actually owned around a year ago before selling out because I thought it was too expensive. But it turns out there's a reason that Snowflake has been so expensive for the majority of the time it's been a public company. So if you think of how data has changed over the years, a long time ago, people wrote their data manually on pieces of paper. Then that moved over onto simple databases on computers. Then that moved into data warehouses and being stored in the cloud. But Snowflake is the next order of magnitude improvement, where data management itself is moved onto that platform. So rather than each individual company needing to hire a bunch of expensive data engineers, they can put that data into Snowflake. But on top of that, because so many companies are putting data with Snowflake, Snowflake is also offering a product called Edges, where different companies in an industry, let's say medical companies, can actually share data along these edges. So if you're trying to create AI models for a specific medical issue, that shared data could actually become a core part of your business. And so if that's a core part of your business, you're probably not canceling your Snowflake subscription anytime soon. Now, I mentioned a second ago that Snowflake has been extremely expensive in the past. We can see that the highest their price to sales ratio has gone is 172, and the lowest it's gone is around 25, with it currently sitting around 33. This means that this company is currently 1/6 as expensive as it was at the peak, which to me signals that this could be an opportunity to get in while it's cheap. Now, this company is still more expensive than the majority of other software companies, but there's a reason for that. So if we look at Snowflake's earnings over the past 4 quarters, they grew their revenue 104% a year ago, then 109% after that, 101% the quarter after that, and 85% in their most recent quarter. The fact is, if a company is growing that quickly, their price to sales ratio quickly gets pushed down if the stock price doesn't rise. So as long as Snowflake maintains a fairly high growth rate going forward, that price to sales ratio is going to continue to get compressed and compressed and compressed until the stock price starts to rise. And based on the ever increasing amount of data and companies moving to the cloud, I don't see any decline in Snowflake services coming anytime soon. Which leads us to my final and largest stock position overall, which is also my highest conviction stock position, and that is Datadog. Datadog I currently own 401 shares of at a value of $40,600, and that's off a cost basis of $35,000. So even though Datadog, like all of these companies, has declined substantially, it's still up around $5,500 from all the different points that I've bought in along the way. Now, as you might guess from the name, name, Datadog is a data company. They make it easy for companies to unite their applications, their infrastructure, and their security all through a single pane of glass. So you can find any inefficiencies in the system and create huge value by combining all your data into one place. And while that sounds good, we really need to look into the numbers to see how big of an impact this is having. If we look at Datadog's revenue, they grew 66.8% a year ago, then 75%, then 83%, and then in the most recent quarter, they grew again 83% year over year. And this is not a small company. This is off of revenue of over $1 billion per year that they are growing this quickly. And we know Datadog's customers like their product by looking at their net retention rate, which was 130% last year. So for every dollar a customer spends this year, they'll spend $1.30 next year. Even without going out and selling any new clients whatsoever, Datadog would still be growing at 30% year over year. Now, Datadog has also recently obtained FedRAMP approval, which lets them work with different organizations within the federal government, which is the single largest customer in the entire world. And similar with Snowflake, companies are only going to produce more and more data every single year. So Datadog is already growing extremely quickly and gathering more market share, but it's also being pushed by the secular headwind of people generating more and more data every subsequent year. So those two forces backing Datadog really push it forward and make it my highest conviction position overall. Now, I know the title of this video was my top 7 stock positions, but I'm going to do one more bonus stock. The last stock that I'm going to talk about is SoFi, which I currently own 171 shares of at a value of $1,000, and that's off an initial investment of $3,000. So it's down by about 2/3 overall. Now, SoFi is in a somewhat similar boat to Upstart, where they're being hurt pretty dramatically by the macroeconomic environment, even if their long-term business vision is still intact. SoFi's goal is to become the one-stop shop for all of someone's financial services needs. They basically want to replace all the legacy banking services where you have to wait 3 to 5 business days to make a transfer and make everything work seamlessly within the SoFi ecosystem. They have 3 main business segments: lending, financial services, and technology platform. Their financial services include things like the SoFi app, and those act kind of like a top of sales funnel, capturing customers and then funneling them into more valuable areas of the company like lending. Add on to this their technology platform, which they see as becoming the AWS of fintech, kind of like all other companies run on the cloud. Now, financial services companies would run on SoFi. Now, in the long term, I do think that SoFi's vision is intact, and I think this company is absolutely going to kill it over the 5 to 10 year timeline. It's just in the short term, since they are in the fintech space, they are going to get hit by things like rising interest rates or a possible recession. And so this stock could trade flat for quite a while going forward. That being said, SoFi is also currently trading at the cheapest price it's ever been in its history, around $5 per share. And that also puts it just around what the actual book value of the company is. So they're basically saying that this company has no additional value beyond its basic component parts, which, based on their strong strategy going forward, as well as their strong media presence with their SoFi Stadium, as well as marketing stunts like donating $50,000 to Ryan Trahan, which I talked about in this video, it's hard to see that this company doesn't have any value whatsoever. And so because of that, there could even be short-term upside in this stock. So that's why this is going to be my bonus stock, even though it's my smallest position in my portfolio overall. So don't forget to check out that link to StockToMe down in the description. Don't forget to like and subscribe, and I'll see you next time.